Hey, good morning, everyone. Marty Missouri here, November 11th, 2022, Friday, with your end of week stock market snapshot. We'll just keep it simple again today. We'll take a look at the weekly, daily, and hourly charts for the S&P 500. As you noticed, just had an absolutely epic day yesterday on that softer than expected CPI print. This morning, we're seeing some follow through, although this morning, frankly, is about news from China overnight about relaxing some of their stiff COVID resistance measures. And that's something we've talked about now for weeks, if not months, as an inevitability that would be inevitably bullish as it occurs for global asset prices. Also, as I did note in the morning written commentary, however, while it does imply that we'll get more relief in terms of supply chain, but at the same time, when you consider the massive consumer that China is, that on net, I'm going to say this is ultimately inflationary going into next year. And that poses headwinds for the market vis-a-vis the Fed. And so it's a most dynamic setup for markets and the economy these days, to put it mildly. As I expressed in the written blog post this morning, if you didn't get a chance to read that, I encourage you to. It was just more of a cautionary essay about wedding ourselves to our theses. I talked about me perusing Twitter last night. I only follow financial guru types, and really interesting to see the emotion as egos get bruised when short-term theses go awry. And it's just a reminder to never do that. The market should not be something that makes one angry when it doesn't go the way they'd like. And emotion is absolutely a negative when it comes to making decisions in the market. Right now, again, as we began to express in late September, we thought the risk reward, if you will, favored a perhaps not small Q4 rally. Had a nice rally in October, and yesterday's CPI just gave a monster boost to that. I honestly, in terms of short-term expectations, expected a pullback today. We're about an hour and a half into the session, so that could happen. But that was until I saw the news last night in China, and immediately that just did a good positive number on assets pretty much across the globe. So that's where we sit today, with the dollar rolling over again quite hard. Recall, our long-term dollar thesis is a lower dollar on a trend basis for perhaps the next several years, which is hugely bullish, frankly, for how we're allocating our core portfolio, with a bias towards asset classes and regions that do well in a weaker dollar trend going forward. Okay, so to the technicals. Incredible internals yesterday, by the way. Literally more than half of the S&P 500 members are up above their 200-day moving average, even though the S&P 500 isn't. So that could be something that pulls the market higher. People will tell you that often that is a precursor to the S&P moving above that level. Well, I would say, yeah, I can see that. It happens. Just like 5% rallies, for the most part, happen during bear markets. I listened to a commentary yesterday from a technician who showed the last 25% moves in a day, up moves, and 16 of them happened amid some pretty steep bear markets. I would say, sure, but 4 of them didn't. And we have no way of knowing that that this isn't the beginning of something sustainable to the upside. And again, as you know, those of you who watch the videos and read every blog, our base case remains that we're going to probably break through our original green line here, which was our original target for the S&P 500, because odds favor recession. But that doesn't have to be that way. We could get, there's a lot of reflexivity in the markets pulling capital in, and who knows, maybe that's all she wrote. Maybe we'll test it, maybe not. Maybe, as our current thesis suggests, maybe we'll break through it. maybe not. At the end of the day, we got to keep an open mind. On the weekly chart, as you can see, this is this week's candle, very impressive. Not an engulfing candle because it didn't capture the body of last week's, but broke above this bullish falling wedge, bullish divergences, buy signal on the MACD, talked about this Wednesday. And here we are right now sitting above the 20-week moving average, and the 200-week moving average is now sloping positively. All good stuff from a technical perspective. The when your daily chart, recall yesterday that I said we're doing battle with the 50-day moving average that needed to break above that and the 38% retracement of this decline. And if we do that in a momentum-filled fashion and up through the 50, that becomes very bullish. I suggested that 3,900 would be that brick wall that the market would struggle with. As you can see, no struggle there. We got a nice gap higher, and we're following through as I speak today. We did, I'll say it again though, get a nice gap higher, and we talked about this. Gaps tend to get filled. So we should expect, and as our base case would imply, that the market at some point, perhaps over the next few days or weeks, will come back down. Could be within the next few hours, of course, will come back down and test this gap right here. And ironically, it falls right on the 3,800. That frankly could be support if this, I'll still call it bear market rally in Q4 continues, a fallback to, test the 3,900 and the 3,800. Frankly, I'd be surprised if we don't see that happen. Where we're going to really see some stiff resistance is that 200-day moving average, which today would fall right at, call it 40.85. And then we've got this, our downtrend line just above that. So certainly some overhead resistance, but that 41.60 is not remotely outside the realm of possibility in such a seasonally strong period with inflation data, getting softer. Fed speakers yesterday, despite the big rally, were fairly dovish relative to the things they've been saying of late. That's our read on it right here. So again, like I told you yesterday, the weekly and the daily looked constructive, and that the CPI could be a big needle mover for the market in either direction. Make no mistake, as I said on the written blog this morning, if it had come in hot, we would have seen something different to the downside, versus what we saw up here. And the bears would be celebrating, and the bulls would be, depressed. It was the opposite. And again, if you didn't get to read that one this morning, please do. I think that'll be worthwhile for you. And then lastly, taking a look at the hourly chart, recall that I pointed to this rising wedge pattern, although we didn't at the time have negative divergences on the momentum indicator, so it wasn't quite the bearish setup we were looking at, but we were breaking below. And I said that's the green light, we're sitting about right here, to go short. The breakdown below, although we would prefer to see bearish divergences here, which we did. And of course, it rolled over when the market rolled over here for a bit. But I said I would wait. I would not do that pending the CPI number. And what a rally we got there. But again, folks, you're looking at a gap. And of course, if you fill that gap on the hourly, you got quite a bit lower here to go. So we'll see if and when that occurs. Now, what we have here, though, is actually just extending that uptrend line and meandering our way up. And this is still moving higher in more or less rising wedge fashion. But even though we're overbought here, at least on the hourly, we still don't have, the kind of divergences here that says this thing's about to roll over. So this could continue to melt higher again after yesterday's big move. You would sure think there's some profit taking, but there's underlying forces that have to do with options hedging and things that we talked a lot about. That going into the weekend could see this thing propel higher. Make no mistake, even if we are going to melt higher and test some level of 4,000 or higher during this Q4, there will be, I suspect, some substantial pullbacks along the way. So the message for today, folks, is keep an open mind. The market is very, very good at making all of us look silly, particularly those who would suggest with confidence that they know where things are going, especially in the near term. I would say the minute you gather that from a commentator, that might be a commentator to go ahead and turn off and look for more objectivity from the folks you follow in markets. Thank you, as always, for watching and listening. Oh, by the way, in terms of the economic update, I hope to get a video out. If I do, it'll either be late this evening or late Sunday evening, and I'll keep it really quick. We're definitely going to score our index. Just looking at my calendar today and through the weekend, it could be that we skip that video this week, but I'll update you on our score the next time around. Folks, thank you as always for watching and listening. Hope you have a wonderful rest of the day and, of course, a wonderful weekend. Take care. Bye-bye.